Hello and welcome to our special session on international monetary law. Why am I saying that this is a special session? Because we are not in the field of international trade law proper here, but a closely related one, namely the currency policies of the World Trade Organization members and how they affect international trade law. These are not completely unconnected fields, quite the opposite, and that's why it makes sense to look a bit deeper into international monetary law. And in this regard, there is one international organization we have to look into in more detail, in particular, namely the International Monetary Fund, which was parallel to the World Bank, established in 1944 in the Conference of Bretton Woods. Remember, this is where the global architecture that is still in place today was established in the late phase of the Second World War. And its basis, its founding document, so to say, are the so-called Articles of Agreement of the International Monetary Fund. This is where you find the main rules on its tasks, what it does, and how it does what it does. But before, we'll start a little bit with the history of the International Monetary Fund. Its earliest phase, obviously enough for historical reasons, as you can see, focused on cooperation and reconstruction. Keep in mind, why was the IMF established in the first place? To prevent what had happened in the interwar period. Hyperinflation, every country on its own, a lack of cooperation, and global economic crisis emerging because one or several significant countries, economically speaking, significant countries, because of their disastrous monetary policies, could obviously have an impact on all other countries as well. So, what was on the mind of the drafters and the policymakers, economists of that time from the end of the Second World War onwards? Cooperation and a focus on reconstruction of Europe, which was ravaged, obviously enough, by the Second World War. This could be described as the earliest phase, and I take these phases also from the World Bank, from the IMF's website. Second phase then was begun with the end of the so-called Bretton Woods system. What do we mean with the Bretton Woods system? This was a system where you had a global leading currency, the dollar, which is still the main currency in international monetary law. However, it was pegged against gold. Why was that done? To prevent inflation. So, in other words, if you had, see here, US dollars, that meant you could take your dollar and there would always be a certain sum of gold you could get in exchange. So, pegging your currency against a natural resource such as gold means that you cannot print it all you want. This is called fiat money. Fiat from Latin, there shall be. We know fiat lux. Here, fiat money means there shall be money. You simply produce more. However, for all those who dislike inflation, and this is the majority of economists, or they only want a moderate level of inflation, pegging a currency against a natural resource, which cannot be reproduced artificially or at will. We all know the stories from the Middle Ages onwards about alchemists trying to produce gold artificially, fake gold, but all of them failed. And this is why pegging your currency against gold means that you cannot print it at will. However, this system was seen as first as being inflexible and that the dollar was somewhat overvalued, causing problems to the US economy, its spending from the time of the end of the Second World War onwards, and in particular military spending. Think of the Vietnam War. So inside the US, there was a demand for more flexibility and, simply put, for more money. That's why under President Nixon, the US decided to abandon the gold standard and to refinance their economic needs, their budget, partly also by printing more money. And what was then begun was a system of floating or flexible exchange rates. This marked the end of the Bretton Woods system. However, the 1970s were also marked by a phase of, how would you say that, of imbalance and also of when the economic system of the world was somewhat shattered with the oil price shock. What happened in the oil price shock was that many developing countries, but at the same time oil-rich countries, oil exporting countries, first flexed their muscles. How did they do that? they showed the world that, in particular, the more economically stronger countries, the industrialized countries, the Western countries, they were still heavily dependent on foreign oil. So once they showed that by reducing the output of oil or the export of oil, other countries would then have troubles. The richer countries would have troubles because all of a sudden, if the oil price rises, that has an obvious impact on their economy. So you could ask your parents or your grandparents about the 1970s and the time of the oil price shock. That was when politicians suggested, okay, maybe we should have car-free days, or maybe we should undertake other reforms to decrease our dependency on foreign oil. And the oil price shock, and this first sign of when the world realized that everything is interdependent and it's not only the more powerful countries that set the tone, that led to a phase of painful reforms, in particular during the 1980s, because the oil price shock and all the currency policies that were adopted in the wake of the oil price shock not only had a negative impact on the richer countries, but also on developing countries. And that during the phase of the 1980s, the IMF played a leading role when helping countries to adjust their monetary policies. For example, think of Mexico. That is the main example in this regard, suffering from an economic crisis and the impact of what happened in the 1970s. 1990s, societal change for Eastern Europe, the end of the Cold War, the fall of the Berlin Wall in 1989, and the Asian upheaval. Many Asian states, on the one hand, were described as so-called tiger economies. They were catching up with other states, but at the same time, you saw in many Far East Asian countries that they suffered from an economic debt crisis. So, and this has a connection to what we describe today as currency manipulation, or some view as currency manipulation. They learned the lesson. How did they learn the lesson? Why did they learn the lesson? Because of these huge debts they had accumulated during the 1990s, and then they needed a lot of support by the IMF, money by the IMF, but the IMF in turn demanded painful reforms. Same thing in Eastern Europe. Think of many economies and their transition from communism or socialism, depending on how you want to classify it, to market-based economies. At the same time here, there was a high demand for support by the IMF, and the IMF in turn requiring significant reforms. How does this connect to today's discussions about currency manipulation? Because many countries, in particular Far East Asian countries, or think also of Latin American countries such as Argentina, they were then keen on preventing a situation where they would have a shortage of dollars, for example, or any other leading currency. However, if they go to the world market and buy reserves such as the dollar or the euro, that could artificially have an impact on the dollar as such, or also strengthen their currency or weaken their currency. But more on that in a few minutes. However, this is the background to currency manipulation, the fear in many economies, in particular in developing countries, that they would run out of convertible currencies such as the US dollar, or could also think of the euro or the yen or the pound sterling. The last phase in this connection is what we describe as globalization and the debt crisis. What do we mean by that? Obviously enough, globalization has many phases, but from 2005 onwards, parallel to the Doha round, many new economic actors, think of the BRICS states, namely Brazil, Russia, India, China, and South Africa, other emerging markets sitting at the negotiating table and therefore also playing a bigger role in economic affairs, making reforms and cooperation somewhat more difficult, but at the same time, the political and relatedly economic landscape had changed substantially. This is about the history of the International Monetary Fund, and we're currently in this phase. We can still see the impact of the 2008 debt crisis, first in the US, then in Europe, and at the same time, right now in the time of Corona and all the lockdowns, we have reason to expect yet another substantial economic world crisis. The age of recession has come back. Good. And this leads us to the basics of international monetary law. What do we mean by that? This, roughly speaking, relates to the trade policies of IMF members. With the end of the dollar as the anchor, as the global anchor currency, which was then, as we said already, pegged against gold, there are now different types of convertibility regimes. So countries are allowed to choose from a variety of options as to how they want to handle their monetary policies. First, hard pegs, second, intermediate regimes, and third, floating exchange rates. And a lot of that in between, or additionally, they could also form a currency bloc. Think of the Eurozone. Hard pegs is what we used to have in connection with pegging a currency against the gold. However, that has nowadays been abandoned, as already stated, but this would also have been described as a so-called hard peg, meaning there's a fixed exchange rate and you peg as a country your currency either to another currency or to a currency basket. A number of currencies where you would say, okay, you don't only want to be dependent on the amount or the value of the dollar on the global reserve market, you also want to peg it against other. You try to find a mixture. That would be what China is, for example, doing. Or you could also peg it, as we said, to a natural resource, however, it's not happening. And one problem with pegging it against only another currency is that it could be overvalued, not your own currency, but also that of the country you're pegging your currency against. What do I mean by that? Think of the example of Argentina. Argentina was pegging its peso against the dollar, and the stronger the dollar became at the end of the 1990s, the more harm there was done to the Argentine economy. Why? Because Argentine products also became increasingly expensive on the global market. However, since the Argentine peso was pegged against the dollar, the Argentine central bank could not simply try to inflate its currency a bit. Why do countries do that, however, in the first place? Because you lose some flexibility. Trust. You can add more trust. If your currency, if you're from a country that is known for inflation or hyperinflation or irresponsible or unforeseeable trade policies adopted by its central bank on behalf of its government, then you can simply peg your currency against another one and say, if you don't trust us, maybe you trust the US dollar. However, at the same time, it means you're dependent on the US dollar. If the US dollar becomes too strong, your own currency becomes too strong, and you're having a hard time, for example, selling your products on the world market because the value or the price you have to pay increases as well. Intermediate regimes, as we already said, that could be a currency basket, or it could also be that you peg your currency against another one, but only as, you could say, some sort of orientation. But you would say within 2 or 3%, you're absolutely fine with some fluctuation. And last but not least, the last way of currency policies that shall be mentioned here are so-called floating or flexible exchange rates. What do we mean by that? That means your currency is being traded on the world market just like any other good. And that also means that supply and demand, just like with any other good, determine the value of your currency. Some 65 countries have adopted floating exchange rates, in particular all Western states, including the United States and the Eurozone, and interestingly enough, also Russia, which means that also the Russian currency, just like the euro or the dollar, can be traded at will, and they have no fixed value. All that matters is trust into the central banks of these countries and whether there is a currency policy. And that also again leads us to the question of currency manipulation, floating exchange rates. What if other countries simply buy up the dollar reserves? And this leads us to one debate we're currently observing in connection with the United States and China. The US has accused China as being a currency manipulator, or at least single individual politicians have done so in the last years, but a significant step was taken in the summer of 2019. What happened there was that the US Treasury designated China as a currency manipulator. Secretary Mnuchin, under the auspices of Donald Trump, of President Trump, has today determined that China is a currency manipulator under the so-called Omnibus Trade and Competitiveness Act of 1988. This is where the Secretary of the Treasury, of the US Treasury, is analyzing the exchange rate policies of other countries, and then if they come to the determination, or if the Secretary of the Treasury comes to the conclusion that there is currency manipulation going on, you designate a foreign country as a currency manipulator, and then as a second step, you could then decide to impose sanctions or any other trade remedies. However, the IMF itself has rejected this view of the US in a report, said that it doesn't back the currency manipulation charge against China. The IMF is reviewing on a yearly basis the trade policies of all of their members and came to the conclusion that China's behavior when it comes to its currencies in connection with the US dollar is not suspicious. It's a regular trade activity and therefore does not share the view held by the US Treasury. However, I'll now refer to a quote by the Peterson Institute and their podcast with Chad Brown and Samaya Keynes. They have a very interesting episode. They always have interesting episodes, but one in particular I would recommend here that is about the trade policies of China from a US perspective and why the US are so, these days at least, so anxious about the trade policies of China. Long story short, it's because of their close relationship. It matters for the US if China, and because China is holding a large amount of US reserves. However, the dollar also matters for China because these are obviously enough significant trade partners. So they're in a mutual relationship where they both depend on each other if they like it or not. But let's listen a little bit to the episode by the so-called Trade Talks podcast on China as a currency manipulator and the guests they have invited to this podcast.
Murray Obsfeld.
The broad concept of currency manipulation is a government intervening in the foreign exchange market to prevent the exchange rate from promoting balance of payments adjustment.
From America's perspective, currency manipulation is where countries intervene to keep their currencies weak and to keep the dollar strong. And they're doing this to help their exporters stay competitive so that exports stay high and imports stay low.
And so that their external imbalances don't adjust. Almost every country in the world has agreed not to do this when they signed up to the IMF, but it does happen.
Now, in practice, when you're looking for evidence of currency manipulation, there are three things that folks have typically looked out for.
One of them is an undervalued currency, although how you determine undervaluation is far from an exact science and involves some element of judgment and some uncertainty. Another, which is easier to establish, is large and protracted one-way intervention in the foreign exchange market to accumulate foreign currencies so as to prevent your own currency from strengthening. A third would be a large and persistent trade surplus with the rest of the world.
I should emphasize that there is a lot of judgment that goes into the first and third of those. It's really hard to know how strong a currency should be. And there's no particular reason why a country's trade balance should actually be zero. So working out whether an imbalance is too big is actually quite hard.
So, as you can see, or as you have heard, it's complicated. What has to be emphasized, and what also was noted in the podcast episode I just recommended, is that there was a bigger case to be made that China was manipulating its currency, or the US dollar, in its favor. However, that was back in 2007, and the issue was not as pressing for one obvious reason: 2007, 2008, the global economic crisis. That's when the US said, okay, we now need to cooperate. This is not the right time to push China to change its currency policies, to push China or put them in the dock to criticize China. We now all have to work together. So if you do sense some similarities to the current situation, the combat against the corona crisis, you're there. It's quite likely that the US, at least if it's reasonable, will also say, okay, let's focus on other things, but this is probably not the right time to wage a trade war on the account or on the basis of accusations that China is manipulating its currency. What is currency manipulation? Once again, the definition, the one given by the Peterson Institute for International Economics, of which Chad Brown is a member, it defines currency manipulation as a situation when a government buys or sells foreign currency to push the exchange rate of its currency away from its equilibrium value or to prevent the exchange rate from moving toward its equilibrium value. So, in other words, to try to bring down the value of your currency to make your goods more competitive on the global market, for example. That's one explanation. We'll come to the explanations as to why countries do that in a minute. But first things first, how do you manipulate your currency? One is you can print more money. And this money that is being printed, you use it to buy foreign debt or foreign currency reserves. What is the effect of that? There is an increased supply of the currency in the country that is printing money. And in turn, a decrease of the supply of the targeted country's currency. So this is a bilateral affair. That's why the US is emphasizing China's role here, and it's why China in turn is focusing on the US. It's a trade war, a currency war between these two countries and their respective currencies. Because the decrease of the supply of the targeted country's currency, as always, demand and supply, shortage of currency, meaning that the currency that is still left becomes more valuable, it increases again, and that makes it more difficult for the US, for example, to sell its products, while at the same time the Chinese, by artificially lowering the value of its currency, benefit because it's for them, it's easier to sell their products. And that's the accusation the US is making. However, keep in mind, as I stated a bit earlier, the IMF report said that the Chinese government and Chinese central bank is not manipulating its currency in contrast to or in exchange with in relationship to the dollar. Why do countries do that? As I already said, making exports more competitive. Long story short, the easy explanation, simply because they are cheaper. Boost economic surpluses for political gain, because countries want to avoid inflation, holding foreign exchange. That's the situation Argentina was facing. That's where many countries also learned their lessons during the late 1990s and early 2000s. It's always important to have some foreign currency reserves to avoid a situation where you cannot service your debts. And last but not least, reducing the inflow of foreign capital into your country. These are the main explanations as to why countries would resort to currency manipulation in the first place. The consequences, and this is where the law comes back into our situation, there are two legal fields that are relevant. One is the IMF agreement itself, which in Article 4 states that countries do not or shall not pursue currency manipulation, but at the same time the IMF agreement is more of a declaratory value. There are no sanctions. There is no explicit naming and shaming. Yes, I just noted IMF reports, surveillance by the IMF, but at the same time, there won't be any direct consequences. It could be that there are individual consequences adopted by other IMF members, but the IMF as such does not have a sanctions mechanism. And another field, and that's the one we're more familiar with after our last sessions, WTO law, trade law. A country could treat currency manipulation as an export subsidy, and export subsidies, these are the types of subsidies that are prohibited. Usually, these subsidies are being granted to say, okay, we will, to put it in a simple fashion, we will give you money if you manage to export your products, or to help you export your products to other countries, we will give you some money for that directly. That is one of the prohibited types of subsidies by WTO law. Therefore, other countries can react by adopting so-called countervailing duties to bring the price, because the price was artificially lowered because there are subsidies. Simply put, it's easier if you have just some money infused into your economy, into your industry by the government. It helps you to remain competitive. But other countries can react and say, okay, this is unfair. This is harmful or potentially harmful to our industrial sectors, to our companies, so we will impose a quasi-tariff. Is the so-called countervailing duty. It's a trade remedy against subsidized products. But at the same time, however, it's highly questionable whether currency manipulation, as we already said, whether there is currency manipulation and whether it can be treated as a prohibited export subsidy. And that leads us to the International Monetary Fund. We just discussed this international organization in this on the basis of this concrete example. From a bigger, broader perspective, what is the IMF for? It's also for coordination of monetary relations in addition to surveillance, and in particular, coordination and surveillance of exchange rate policies by its respective members. Plus, what it also does is it lends assistance to members facing economic difficulties, balance of payments problems. You cannot pay your debt. Then the lender of last resort, that's the IMF. That's where you would go to if you have nowhere else to go to, in other words. Plus, what you do here, or what is necessary here, are stable, what is the overall aim, are stable exchange currency arrangements and free convertibility of currencies as cornerstones of international monetary relations. That's the broader picture here. The aims of the IMF can be found in Article 1 of the IMF Agreement articles: promotion of international monetary cooperation. Second, the facilitation of the expansion and balanced growth of international trade, hence explaining why we are dedicating a special session on the International Monetary Fund and international monetary law. The promotion of exchange stability as a precondition for international trade, assistance in the establishment of a multilateral system of payments, so convertibility, that you can go to with your currency and in exchange get currency from another country, and as we already mentioned, making resources available under the condition that there are adequate safeguards. Remember the Washington Consensus, to members experiencing balance of payments difficulties. And I quote here Article 1 of the IMF agreement. And first, monetary cooperation, growth, high levels of employment and real income, and the development of the productive resources of all members, which are primary objectives of economic policy, exchange stability, here the multilateral system of payments, then making general resources of the fund temporarily available, and shortening the duration and lessening the degree of disequilibrium in the international balance of payments. So, in other words, that's good. Plus, and now I shall briefly refer to Article 4, where you find some of the obligations of IMF members, so of almost all states, since they are bound by the IMF agreement. First, they shall endeavor to direct their economic and fiscal financial policies toward the objective of fostering orderly economic growth with reasonable price stability. In other words, no hyperinflation, with due regards to their circumstances. Then every member shall seek to promote stability by fostering orderly underlying economic and financial conditions and a monetary system that does not tend to produce erratic disruptions. Stability, in other words, that's the key here. Then avoid manipulating exchange rates. This is where you find the obligation we've already mentioned. In other words, no currency manipulation, but at the same time, quite often it's very difficult to detect whether there is such a currency manipulation in the first place. Sometimes it's also something countries could do for other reasons, and that's also perfectly reasonable, plus understandable and justified currency policy. IMF itself then, its characteristics. Let's focus a bit here what the IMF is actually doing, its main tasks, which are 5: surveillance, financial assistance, capacity development, and in this regard as a key measure or key tool in its box, special drawing rights and its resources. Surveillance, meaning that it simply oversees the international monetary system by monitoring the economic and financial policies of all 189 members. So, as you saw a bit earlier, a report on the Chinese monetary policies saying, okay, are they manipulating the currency, yes or no? You will find that perhaps it's not a naming and shaming, as you know from human rights law, but what you do find is the report says, okay, what have the Chinese actually done? In other words, this is also necessary to prevent IMF members from trying to do something in disguise. It shall be as transparent as possible. Then, in addition, monitoring regional, global economic trends and also seeing what is the impact of the respective trade policies by countries or by international organizations such as the European Union. What is necessary here to remember is that this is the outlook that the IMF provides. It says, okay, something is going on. This could have a harmful impact, and then there shall be a gentle reminder in consultation with the IMF member states. Okay, we've noticed a certain trend in your region or by your state, what you're pursuing, but on the long run, this could cause some problems. Financial assistance, then. This is if there's an actual or even a potential balance of payments need. So you do realize the state, wait, in a few months we'll have a problem to service our debts. You can always request financial assistance at the IMF. And there are two types of lending agreements: non-concessional lendings and concessional lending. Non-concessional lending, that means the interest rate is based on the interest rates you would find on the regular market. Therefore, however, you don't have any strings attached, or not more as on the global market. Or concessional lending, this is where you make concessions. This is where reforms or huge reforms are being required in turn in exchange for lending. This is in particular vital for low-income countries. However, why do low-income countries do that? Poorer countries do that because of the zero interest rate. So they get money, they don't have to pay interest, but at the same time, they have to make certain concessions because the IMF is interested in ensuring that this won't happen again, or that they will increasingly over time have more sustainable fiscal or economic policies. And this relates to the next point I would like to address here: capacity development. This is what you would call another form of development aid by training economists, by building up institutions, a functioning central bank, a functioning Ministry of Finance or of Trade. This is where the IMF is also involved. And how is it done? How many of these measures and these aims are being achieved? One important tool that deserves to be mentioned here are so-called special drawing rights. This is, you could say, IMF money. The IMF's own currency you wouldn't find regularly on the market. You can't buy, let's say, an IMF dollar. That doesn't exist because this is a global reserve asset, providing the IMF with liquidity, with its own money. And however, this is additional to the official reserves. It's the unit of account of the IMF based on a basket of the 5 major currencies: the dollar, the euro, the Chinese renminbi, the Japanese yen, and the British pound sterling. The lead currencies, and on their basis, the special drawing rights are being determined. And at the same time, however, there is a potential claim on the freely usable currencies of IMF members. They can be exchanged for so-called IMF money. And where does the IMF get all of these resources from? From quotas. In other words, what do individual members pay to the IMF? And this is the reason why the US, or more generally Western countries, are having much more influence than other countries. It's because this is one of the international organizations where the old principle of one state, one vote is being abandoned at the IMF. This is where you have the other principle that you're probably also familiar with. He who has the money, or she who has the money, is the one who is making the orders, the one with the power. Money equals power. With the international financial institutions, that's definitely true because the voting rights in the IMF are based on these quotas. So on the financial contributions member countries are making to the IMF. So that means that Austria, as a comparatively small economy, has only 0.81% of all voting rights. Germany, as a much bigger economy, has 5.42, Switzerland 1.18. Serbia, in contrast, for example, only 0.16, Turkey 0.95. Large country, large population, but not contributing to the IMF as much as other countries, such as China, which on the basis of its contributions has 6.09% of the votes. Russia, then, economically speaking, not a powerhouse, but at the same time, however, as a large country, still contributing significantly more than, for example, Austria has 2.59%. And last but not least, the US, as the most powerful country and the most powerful member in the IMF, 16.52% of the votes in their pockets, you could say. Good. This leads me to conclude our session on international monetary law. Long story short, certain obligations under the IMF agreement, the IMF itself as the primary institution in this regard, but keep in mind, however, there are also regional arrangements, in particular the Economic Monetary Union for the European Union. But however, this is beyond the scope of today's session. Good. Thanks for paying attention, and I'm looking forward to the next session, which will focus a bit on the World Bank.